Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin. I hope you're all doing well. I'm going to say hello to folks as they're coming in. Hi Aaron, hi Emil, Nisa, Sammy, Van. Yeah, good to have you guys on board. Looking forward to this session. If someone could just type in the, hey Sammy, that's great. You've preempted my question. Just checking you can hear me, that I'm coming through with my sound and that you can see the screen okay. Okay, that's good. Just as folks are coming in, I'll just go through the normal disclaimer. Yeah, that's great. Thanks, Sammy. Just to make it clear that as we're looking at this workshop, discussing different trade ideas, different currency pairs, what this isn't is this is not a signal service. So the whole idea of these workshops are to show you guys, how I as a professional trader go about analysing the markets, finding which currency pairs which have an opposite outlook, and it's not trading advice. So this isn't like a signal service, just to make that clear. It's all about education and helping you guys get to a place where you don't need someone like me and you can just make your own trading decisions and carry on your trading journey. So that's just to make that clear. With just the outline of the session ahead. Oh, let's go back. One of the things that's important, and this is underlined with this week, is that market dynamics change. Many of you who've been involved in the market realise that. So oftentimes, what can be a very sensible idea on the Monday can be, not a very sensible idea by the Tuesday. And sometimes even from hour to hour or even minute by minute. So that's one of the reasons why you should never take this as trading advice, and indeed from anyone, because the market is dynamic, and as soon as even the best advice is given, it can change given the market mood. Okay, so looking at the session ahead, we will be now. Originally, we were looking at a special topic of the Australian and New Zealand central bank divergence. Now, that is what I had gave to my team for last week around Thursday. However, the situation has changed. So the Australian New Zealand dollar is no longer going to be a focus for us. And the reason that trade suddenly became, the divergence between those two central banks changed was due to the reapplication of extra tariffs by Donald Trump on to China, and all of a sudden the Australian dollar was hit very hard, and so that Australian dollar weakness was quite pronounced through the end of last week, if you remember, the start of this week. And so all that Australian dollar weakness affected this potential central bank divergence between the Australian and New Zealand central bank. Both those central banks are meeting this week, and I was beginning to see a picture with the Australian bank was going to be the RBA was going to be more bullish, and the New Zealand central bank potentially more bearish. So I could see a potential Australian New Zealand dollar long, which is what I was looking for, expecting to find sellers at support. However, that trade is now obsolete. So I've had to choose another special topic. So the good news is I have chosen a different special topic. And what we'll be looking at is we'll be looking at the New Zealand central bank meeting coming up overnight for me here in the UK, about 3 a.m. my time, 4 a.m. 2 a.m. GMT time, and we'll be looking at what's going to happen with the New Zealand dollar. So we'll look at various outlooks so we can get ourselves prepared for that rate meeting. Always want to be prepared for rate meetings, and this will just serve as a good kind of outline for you. Okay, on the handouts, don't forget we've got the workshop guide here. So if you go to the GoToWebinar control panel, what you'll see under the handout tab, you've got the handout, and I tried to divide this webinar, this workshop, following these 5 titles: looking back, looking forward, looking at the charts, looking at your risk, and then looking at the outcome of your trade. So I try to have 5 basic pillars, as it were, for trading, and these are the 5 foundations which I use on a day-to-day basis. I just use it intuitively. I just do these things through intuition, and just through habit. I've done so much, it's automatic process. But until you've really got yourself a decent trading routine and trading setup, and you know what you're doing each time, you use this template as a foundation for beginning to build your trading on. So that is there in the go-to webinar control panel. Print it out, download it, and then you.
Very interesting.
Oh, sorry, I'm just going to turn.
It's
something.
Just at the 1.1.
Apologies for that. That is every now and then my Telegram channel comes alive, and that was a message I put on the HYCM Telegram channel about the euro-US dollar pair. We'll have a look at that as well during the time. Okay, so we've got the handout. If you pull your handout out, make sure you use it. We'll be referring to it during the session. If you have any questions or suggestions for topics that you'd like covered, I like to do a special topic each Tuesday. So if there's a special topic you would like particularly to see, then just email me there and let me know. It'd be good to hear from you guys anyway. Oh, my Telegram channel, Sammy. Yeah, that is the HYCM Telegram channel. So if you just go on the HYCM Telegram channel, I do all the updates for that HYCM Telegram channel. It's a really good resource, and if you're not using the HYCM Telegram channel, you want to get onto it. So yeah, just use that. I was doing an update today, a video update, and I also do audio updates, as well as I write the material for that channel. Okay, Sammy, I hope that answers it. And don't forget, there is a questions panel. Please do ask your questions during the webinar, and I will get to them at the end, if not before. Sometimes I try to deal with the questions as we go along, and if it's better to wait to the end, I can maybe wait to the end. Yeah, hi Nadir, good to see you. Okay, so let's move on. So what we're gonna, the big picture, and this is what I want to really highlight, is what we're trying to do as currency traders is we're trying to find currencies that have an opposite outlook to each other. So we're looking to find a strong and a weak currency. And the reason we want to find currencies with an opposite outlook is because it's easier to see the direction of the currency if we know they have opposing views. It's a bit like, I've used this illustration before, it's a bit like with a fight. Okay, if you want to guess who's going to win a fight, you would think, well, okay, well I guess the stronger person is going to be the weaker person. And that's what we're trying to find with the currencies. We're trying to find the stronger currency because we know that the stronger currency is going to win out over the weaker currency. So we're always trying to pair the strongest currency against the weakest currency because that gives us the best opportunity and the best potential for trading. If you want to turn to your handout, and we'll start off by looking back. And we're looking back, identifying the recent sentiment by reading up on the last two sessions of market activity. And then we want to identify that key market sentiment and try to summarize it in a sentence or two. Now, you know, at first, when I first did this, and some of you guys will know on the, you know, who've been coming to this workshop for a while, I started going through a lot of material. And as I've been reflecting, I'm thinking, actually, it's not so helpful to go through so much material because actually, what we're trying to find the main sentiment that drives the currency, okay? So that's always what you're trying to find is what is the main driver, what's the main mood? And sometimes it's not always clear, okay? And at times when it's not clear, oftentimes beginner traders or people who love trading, just because they love trading, they'll end up getting into a trade. But there isn't really anything very clear. So start to get into that habit of if you can't make sense of them, if you can't, you know, achieve pairing up a strong currency against a weak currency, if you can't find that, then what you want to think to yourself is, oh, hang on, you know, then there's no trade for me here. I've got to wait till something's clearer. And oftentimes something clear will come in. There'll be, you know, something will move the market. There'll be some fresh event mid-session. There'll be something that comes along, even if there isn't something at the moment. So just to be aware of that dynamic. And just to say, I'm going to try and focus on the most significant market sentiment. Now, the context of the market we're in at the moment is, at the end of last week, Friday, Donald Trump said he was going to put some extra tariffs on about $300 billion worth of Chinese goods coming into the US. And as a result of those extra tariffs, the market suddenly became very concerned. There had been some positive tones between the US and China on trade talks that quickly receded into the background, and then it became a really strong risk-off environment. And as we were doing the FX webinar week look ahead yesterday, we saw that it was a real perfect example of a risk-off market. We saw that equities were falling, commodities were falling, the volatility index was up, bond prices were rising, bond yields were falling, and then we saw the traditional safe havens in play. The yen was being bought, the Swiss franc was being bought, gold was being bought. So it was a very textbook safe haven play. So last night, we got the sort of the Asia's response. Now, the way to work with the equity markets kind of follow each other around the clock. So, as the US equity markets close, and they closed down substantially, there's been a substantial fall in the US equity markets over the last couple of days, and the Asian markets were kind of following that for a time, but then they just recovered from the extreme lows. And what was happening is that the kind of free fall, the kind of that continued flow out of equities didn't stop, but it was less, and it was a lot less. So there was some recovery from the lows of the day, and the reason for that recovery was it's a tricky one today. But what happened? The People's Banks of China had a different fixing rate for the US dollar Chinese yuan. Now, the US dollar Chinese yuan currency pair is a very politicized currency pair at the moment. I'm just going to get it up here and show you so you can see what's going on with it. I'm just going to call it up on my trade view. That's it. And now that's it. Okay, here we go. So here's the pair. I'll get rid of the pivot points just to make it clearer. Right, for quite a long time, you see, this is the US dollar Chinese yuan pair. Now, for quite a long time, this 7 level was seen as the level.
At a very interesting point.
Oh, I'm sorry.
It's just at the 1.1200.
Sorry about this.
There's bearish reasons.
Every now and I'm going
to sellers.
Yeah, I'm going to quit the Telegram channel. I don't know why it's doing that. So this 7 level was rumored to be the level at which the People's Bank of China would intervene to prevent the weakening of the yuan. Now, what happens with the People's Bank of China is they've been very concerned that if the yuan weakens too much, capital outflows will move out of China. So there is a big incentive for the Chinese government to not allow the yuan to weaken too much, and on this kind of this risk aversion, this shot through the 7 handle, and it was seen that the People's Bank of China allowed that to happen. They had their fixing rate, and they didn't fix it to keep it below. So as a result, it was seen that they're just not intervening. They're allowing the yuan to weaken. That prompted Donald Trump yesterday to talk about currency manipulation. Now, it wasn't strictly currency manipulation, but now when we come to overnight, the fixing rate was to stop the weakening of the yuan. Okay, so that fixing rate, and they issued some bills, and those 2 moves, the fixing rate and the issuance of bills, meant that the yuan weakness was just halted. Okay, so we've broken through that 7 level, so you can see the price is looking like it's moving back down towards that 7 level. And this was, this happened at the end of the in the middle Asian session when I came to my desk, sort of around 5 8:15 a.m. This morning. That had just occurred, and we were just beginning to see the market digest that information, and that's carried on. So you can see that I took a shot of the markets to show you how this happened. Look, so there's the S&P 500. Okay, so the S&P 500 here is 2850. I'm looking at my chart here, and I've got it at 2844.74, and I've got the S&P 500 futures market up 2855.90. So in the Asian session, we're starting to see recovery in the S&P 500 futures market. You can see, look at the way that the markets have been falling. 1, 2, 3, these big down days, with Monday being a heavy down day. 1, 2, 3, 4 days. That's down the Dow Jones. You had the FTSE 100. Those 2 big days, down. We're currently UK FTSE is currently 7218. So we are halted some of those quick lows. We're not out of the woods yet. And the Nikkei was down, as we recognized here, at the 0.65%, and it's the 2585 level, and the Nikkei futures are around just above flat at 0.5%. So a couple of things to say for us. First of all, the reason currency traders will look at the equity markets is because the equity markets are very, very sensitive to risk. Okay. Now, as soon as there's perceived to be risk in the globe or in a country, investors take their money out of equities, okay, and they'll put them into things which are lower risk. So traditionally, investors would rotate out of equities and they would buy government bonds. Remember, government bond is simply a loan. If you and I want to take a loan, we might go to the bank. When a government wants to take a loan, because of its huge size and the huge amounts of money involved, it can't just go to, it can't go to a bank because its capital requirements are too high for any single bank. So instead, it issues a bond, and these bonds are sold. So when a country like the US wants to borrow some money, it will issue a bond. And of course, a country like the US has huge resources. So the debt, lending money to the US is seen as a very high grade bond. That's AAA status. That's the best, most chance of having your money paid back because they have such a huge amount of money. So that's typically what investors do. When they're concerned, they move out of equities and into bonds. So that's why you see the relationship. That's why you see equities falling and then bond prices rising. But one of the confusion that traders get is that often the bond yields are quoted, and yields move inversely to bond prices. Okay, so basically, what the relationship to get in your head straight away is this: if I've got falling equities, you're then going to see a fall in bond yields. Okay, the bond price will rise, but the bond yield will fall. If that's difficult at this stage, don't worry too much. But the easy takeaway is that FX traders look at the equity markets to establish risk. I always, one of the first things I do is I look at the Nikkei overnight as I come to the European session in the UK, and about a percentage point is significant. So if you have a plus or a minus 1%, I'm really paying attention to that equity market. Obviously, sometimes if it's up 0.7, up 0.06% or 0.12%, it's less important. But obviously, you can see the percentage falls on these days have been significant and high. So that was the situation we got to in Asia. Okay. Now, the other significant event we had in Asia was the Reserve Bank of Australia rate meeting. Now, they've said that they will adjust policy if needed to support the economy, and they're going to monitor developments in labour markets closely. They're saying the outlook for the global economy remains reasonable. House prices are stabilising. They're thinking that economy can sustain lower unemployment rate, and unemployment is to fall below 5% during the next couple of years. They extended their projections for inflation. Now, they're thinking it's going to take longer to reach 2% inflation target than they'd originally expected. Wage growth remains subdued, a little upward pressure at the moment. On Australia's economy is expected to grow 2.5% this year, and inflation to be slightly under 2% next year. So there was a slight revision of some of those projections. Now, again, I will say to you, look, this is, I will just get up the Reserve Bank of Australia website, okay, because a good habit to get into is to go to the central bank's website and read the statements for yourselves, okay? So just there, this is the statement, this came out yesterday, and you get some really good clues, okay? So not only do you get some clues about what's going on in the world, you know, if you're needing to pick up on what's happening with China and Asia, and this, you know, reading these reports can be very helpful. Well, you know, you also get these little nuggets, like here. This is how the statement ended. So the board will continue to monitor developments in the labour market closely and ease monetary policy further if needed to support sustainable growth in the economy and the achievement of the inflation target over time. So in particular, you know, this is something they've been saying before, but they're still maintaining it. They're going to monitor developments in the labour market closely, okay? So what they're telling us is that, you know, labour market developments are very important for the Reserve Bank of Australia. So then, armed with that information, you can then go to, you know, something like, you know, a free thing like Forest Factory, free, and then just, you know, put in your filter, take all the currencies out, just add Australian dollar, and then put in, you know, this month, apply settings, and look for the next labour data. And you can see, look, okay, so here's a statement, August the 6th. We've got Governor Lowe speaking at the end of this week. Again, that's an important monetary policy statement, another important event. But you can see, okay, hang on, I've got employment data out here, August the 15th. So you can know that you know, that event is potentially market moving, because if you get a good employment change, good figure, and the unemployment rate drops low, you know, that's going to be really positive for the Australian dollar. They're going to, you know, and similarly, if that's a miss, if the employment change is, you know, a negative number, and if unemployment rate is rising, you know, oh, hang on, the RBA are looking closely at labour market, and that's going to be very negative for them. So that is a very, you know, interesting, you know, that's a sort of clues that you get. And so going into the event, say on the weekend, on Monday, you come to your desk and you can see, say that employment number is expected to be good and the unemployment rate is expected to be low, you know that that will be seen as very positive for the Australian dollar. So you could know, you know, traders would be looking to, you know, buy the rumor and sell the fact in that situation. So that's just a little, you know, just a little tip to give you. So when you read the actual minutes for yourselves, you'll pick up that. Whereas if you might, you know, read a report or something on analysts, they may not bring out every relevant detail, okay? So looking at it for yourself, you'll be less likely to miss those details. So at the end of the Asia session, as I was writing this, you know, we're looking at the equity markets today to get a handle on risk. So we want to know, are we going to see the risk-off market carry on or not? You know, the way to kind of get the front handle on that is going to be looking at the equity markets, all right? So what are the equity markets doing? And if we have the equity markets falling, then we know we return to that risk-off sentiment. So we're going to see yen strength, Swiss franc strength, gold strength. If we see equity markets rising and keeping into positive territory, we know that at the very least there's a pause. Now, don't get me wrong, this recovery is not a permanent reversal in risk, and there's a lot of risk out there. But it's stopping this immediate fall, okay, for today. So that's the sort of time scale we're looking at. And the risk out there is large. And I haven't shared this for a while, for those regulars will know it. But China and the US, between the two countries, that is around 40% roughly of the world's entire production comes from these two nations alone. So with these two nations, not getting on and having the trade disputes and the tariffs and the issues over intellectual property and all the countless issues that are going on at the moment between China and the US, that drags on the whole global economy. So this is why the market is being so risk averse to the China and US trade wars, in a way that it wasn't with the US when US had the disagreement with Canada and Mexico. So you look at where's Canada here? Here's Canada 2%, and where's Mexico? I don't even know where Mexico is on this. Yes, Mexico. So US, Mexico, and Canada. In US, when they had the NAFTA agreement, which became the USMCA agreement, you can see there they got 25, 27, 20, around 29% GDP total of that. But the majority is with the US. But you can see the US and China are much more equivalent nations. So there's a lot more at stake. So that's just a way of saying we're not out of the woods yet. With even if a risk does recover for today, those equity markets have fallen quite a long way, and be very alert in this kind of environment for another tweet from Donald Trump. It only takes one more tweet of him saying we're going to increase the tariffs, those 10% tariffs that are due to start 1st of September, I'm going to increase to 25%. And then all of a sudden we're right back in that risk scenario. And we know from Donald Trump's actions, he really likes tariffs. And from his perspective, it's very convenient. He can just sort of, pick up his Twitter account on his iPad or his phone, send a tweet, and he can move markets at a whim, really. So, okay, so that was the, that was the big picture going into Asian session. We're recovering from very, very strong risk-off sentiment, and looking at the equity markets at the moment as we're here. We're looking in the European is broadly up. We've got the FTSE flat, Euro stocks up, French 40 up 0.77%, DAX up around 0.5%, Portuguese and Italian FTSE both up over 0.5%. Not huge moves, but just recovering off those lows. The S&P 500 futures currently up a percentage point at the moment, so looking strong for the S&P 500 going into the start of the US session. Dollar index, we're seeing a lot more dollar strength now. It's at 97.72, up 0.21%. So that's looking good for the dollar index. Okay, Asian session. We had some more news for the pound as well. And the market was kind of digesting an article reporting that European diplomats have been told that Boris Johnson has no intention of renegotiating a no-deal Brexit. Okay, so in the UK the tone has shifted. I live here in the UK, and Boris Johnson's approach is entirely different to Theresa May's. Boris Johnson is really going for a no-deal Brexit. It's quite a difficult political climate here in the UK because just over half of the people voted to leave the EU, and just under half the people voted to stay in the EU. So it's been a very divisive issue here in the UK whether you remain or leave the European Union. So you can see why Theresa May was quite, she was sitting on the fence a little bit. Naturally, she was a Remainer, but she was responsible for bringing Britain out of the European Union. So her heart wasn't really in it, to be honest. You can imagine, because she voted to remain, but then she had to bring the country out. So it's much more difficult for her to, with a full kind of conviction, to bring Britain out of the European Union. Boris Johnson is a Brexiteer by conviction. So it's much easier for him to get Britain out of the European Union in terms of his own personal psychology. And so he's implemented a very pro-Brexit cabinet. He's posturing for a no deal. He's not afraid to embrace a no deal. So this has meant that, Europe's diplomats are starting to digest that. It's not okay. It's different when you live in a different country. Okay, that's starting to become clear, and the market has generally been pricing in more chance of a no-deal Brexit now. And Boris Johnson said that even if he lost a vote of no confidence, so if the Labour government motioned a movement to say a vote of no confidence in the government, Boris is saying even if he lost that, he wouldn't resign, so he could push through a no-deal Brexit. This is because the only time a vote of no confidence could be called now would be in early September by the Labour government. And even if Boris Johnson lost a vote of no confidence, he has the option to set the next election date. And he could set that beyond the 31st of October, which is the date Britain is currently scheduled to leave the European Union. So he's saying that he wouldn't resign. He would make sure he got that no deal through. So he's absolutely resolved. So just to say, the chance of a no-deal Brexit is not fully priced in by the market yet. So there is more potential pound downside as Britain heads towards a no-deal Brexit on October 31st. A lot of people, until recently, the base case was still for a deal to be done between Britain and the EU. However, it's starting to move towards more and more likelihood of a no-deal Brexit on October the 31st, and that's being priced in. That's why we've been seeing a lot of the pounds falling heavily in the last, couple of weeks in particular, and there may be more to come. So there is negative sentiment for the pound. So in this kind of environment, what you're looking for is say you get a good data point that comes out, the pound rallies, but then the pound is going to be sold because the Brexit concern is still there. So this is a situation where, as traders will be looking to sell the pound rallies. Okay, so any uptick in the pound will be seen as an opportunity to sell the pound at more advantageous prices. So remember, we're trying to look at, strong currency against the weak currency. So going into the Asian session this morning, we saw, going into the European session this morning, for me, it was obvious that the weak currency was the pound and the strong currency was the yen. So looking at the charts, I'll just pull up the pound yen chart, and so we can see, we've done our homework. Okay, we've done our homework, and we recognise the pound yen is the pair we're going to see some negative sentiment. Okay, looking at the daily chart, I can see the price moved up into that resistance level, which is the 130 level. It's the support one pivot point. It's just a key place to where we're going to see resistance. On the 1 hour chart, we're moving up to that 1 hour 100, 200 exponential moving average pivot point here at 131, and going down on a 15-minute chart. Now, in this kind of scenario, what you can do is, if you want to short something, but you don't know how far it's going to retrace, one little technique is to use a trend line. Okay, so you can use a trend line, and then when you get the break of the trend line, okay, you can, say the trend line was there, or maybe even there, you could have used the break of that trend line as a trigger to enter short. That way, okay, you might miss out on a few extra pips, but if the price keeps retracing up against you, you're getting in at better levels. And obvious places for a stop. Obvious places here. You're looking for places where, okay, where you're definitely wrong. Okay, so for me personally, if I was shorting this pair, I might look on the 1 hour chart, and you might look at the 132 level. That seems a fairly good place. You're above the pivot point, you're above the 100, 200 exponential moving average, and then you're targeting back down towards those lows at 12838. And if beyond that, you've got the pivot point at the S1 level. Okay, so that's the kind of, everyone has kind of a different technical way of viewing the market. I use the market through moving averages, pivot points, Fibonacci retracements. That's how I like to view the market. There's a number of different methods out there of trading. So, but that's the most important thing is you get that right sentiment. You get the right currency pairs to be trading against each other. So obviously, what we're looking for, you're looking for, if equity markets suddenly start falling, then we're going to see the yen being bid, and you're going to see the pound yen going off to the downside. Another alternative to the pound yen might be the euro yen, because we know the euro is really negative at the moment because of concerns about the ECB cutting rates in September. So you can see there's a lot of negative movements on the euro yen pair. But moving up to that S1 level, you can see that there would be a potential place to short, and even up here, the 121 level. So going forward, if we got a retracement up to this level, I'll be very interested in selling from here, and just putting your stop above the 123 handle, which is above the next resistance point. So that's a level where I expect to see sellers on a retracement up to there. So again, it's a tentative recovery. That tentative recovery from Asia has continued, but it is tentative. So the way to see which way it goes is to look at the equity markets. How are the equity markets moving? Have a sense of them. If you aren't following the equity market, start doing so. And you can go to a website like teletrader.com, or there's loads of different resources out there. Trading View. You can look at the main indices. And the indices you want to look at the S&P 500, the Dow Jones for the US, and you want to look for the UK FTSE 100, DAX, French 40, Euro stocks. And for the Asian indices, you want to look at the Nikkei, the Hang Seng, and the Shanghai Index. Okay, so they are, good representatives of those major financial zones in the world. European session, there's no top tier data out during the European session. So because there was no top tier data out, there was something in particular, I just maintain that weak pound, strong yen bias. Again, alternatives could be euro yen. With the pound, just saying, the COP position short in the pound. Again, the commitment of traders report, it's published each week on the Friday, and you get the net positions of institutional hedge funds, large position traders, and you see where people are positioned in the market. Now, it's very helpful to see when people are on the wrong side of the market. So today it's helpful for us to see, look, those short positions have been added to. So the net short in the pound, 90,000 contracts short in the pound, is the largest short there's been since 2017 in the pound. Okay, so that's a huge number of shorts, and they're up from 79,000 from the week before, and that week was up 6,000 or 7,000 from the week before that. So we've had this continual increase in pound shorts. Now, if there's obviously, this is also worth being aware of, when the market is highly positioned one way, when you get a change So say, for example, some positive Brexit news came out, that would be incredibly positive for the pound. So if all of a sudden, you know, Boris Johnson and Michel Barnier say we've struck a deal that's going to be great for the EU and great for the UK, you know, don't worry, there's going to be a deal and it's going to be good for both of us, and you know, it's really optimistic, then the pound will be rally very strongly, and that would just be a trade. You know, it's a sort of once a year kind of trade. You would just get in with full conviction, because you know all those short traders are going to have to be unwinding their positions. All those people who are short are going to be closing them and initiating longs. And so when that happens, you know, the pound is just going to soar. It's going to soar against almost anything. So in that sense, it wouldn't even probably matter which currency pair you got in. You know, to a certain extent, because the pound would just, certainly in the short term, it would just dominate and overrule. So that's just a little tip for you guys. Yeah. So European session, I was just noticing here the positive risk tone slipped. So you can see this was, okay, this is just helpful for you guys to see how this changes. I'm just going to take a screenshot of the indices now. So that's just here. Right, you can see here, look, the S&P 500 futures are now at 1.27%. They were just under flat. The volatility index was up 5%. It's now down 12.97%. You can see the European bourses as a whole were down. You see they're now up. The Nikkei was up 0.43%, but it ended up being closing down 0.65%. The Nikkei futures was down, but the Nikkei futures now is up 0.15%. So, you know, I've got the dollar index is up 0.22%. So a real strong reaction back from the dollar. So that's just to say that's how we're navigating our way through this market now. We're allowing the equities to kind of be the lead for us. So if you get a big move in the equity markets, that's going to translate into currency markets. And I think I shared with you on Monday. I shared with you here it is. Yeah, I just zipped it. So this is the intermarket correlation. So if you haven't got this down yet, just take a screenshot, and this is the this is the relationship between the two. When you've got a lower volatility index, stocks are going to rally, commodities are going to rise, bond prices are falling, bond yields are rising, get risk on. Risk on FX trades, we see yen, Swiss franc weakness, and we see Australian dollar and New Zealand dollar strength. We see the commodity currencies increase. When we've got a higher volatility index, when you've got stocks falling, commodities falling, bond prices rising, yields falling, get risk off. So that's when you see yen, Swiss franc strength, gold strength in certain circumstances, and it's when you get Australian dollar and New Zealand dollar weakness. So oftentimes the currency pair that is traded as a proxy for global risk is the Australian dollar Japanese yen pair, because it's a very sensitive pair to risk. So if it's in a risk off environment, then you're going to see the Australian dollar Japanese yen pair fall. If we're in a risk on environment, then you see Australian dollar Japanese yen pair rise. So it's a very good kind of correlator for those different scenarios. Some free resources to work out sentiment by yourself. Just screenshot those if you haven't seen them before. Looking forward, now as we look forward, what we're looking for is the main event coming up tomorrow, which is the official cash rate for the Reserve Bank of New Zealand. Okay, big event. It's one to hit if you can, because there's potential for trade. Now this is what I wanted us to look forward to. This will be our kind of special topic for the week. This is where potentially we want to see how the RBNZ decision is going to affect the New Zealand dollar. Now, the predominant outlook for the New Zealand dollar is it's bearish. The Reserve Bank of New Zealand, they cut interest rates in May due to a slowing domestic picture and concerns over the global economy. I think it was the first time since 2016 they cut interest rates. Recent data points have held up. CPI was good, GDP was good, but one of the focuses for the RBNZ has been the business outlook, and confidence levels in business were amiss again at minus 44.3. That was just out last week. That was negative for the New Zealand dollar, and it raises concerns for the outlook for New Zealand. Now, there have also been some reports that the RBNZ has been researching how to use unconventional monetary policy. In other words, how to use quantitative easing. So these factors have been, weighing quite heavily on the New Zealand dollar. So going into the rate meeting, the expectations are that there's going to be a rate cut, and it's about 90% chance seen that there's a rate cut. So what will happen to the New Zealand dollar? So here's the main sort of three different scenarios we've got. Okay, if the RBNZ is more dovish, so say they downgrade the future outlook, just, they start saying, okay, we're going to have, lower inflation, we're going to have more rate cuts needed in 2019. We've also been thinking about quantitative easing. That would be very dovish for the New Zealand dollar, and that would be a strong New Zealand dollar sell in that scenario. Okay. Scenario 2, the Reserve Bank of New Zealand cuts, but they change their tone to a more neutral footing. So this could see New Zealand dollar strength on a kind of sell the rumor, buy the fact type of trade. So this would be they cut as expected, but then in the in the statement they're more upbeat than the market was expecting. Then even though you got the rate cut, you're going to see New Zealand dollar strength. So the tone of the statement is important, right? Okay, because that's how you tell the difference between scenario 1 and scenario 2. Okay, both of these scenarios cut, but it's how they give the forward guidance that will make the difference going forward. Third scenario, and the most unlikely scenario, but it's just worth being aware of, if they don't cut rates and they're positive on the domestic economy and they say further rate cuts are not necessary, then we will see some strong New Zealand dollar buying into this event. Okay, now it's unlikely that this would happen, very unlikely, because it's against the run of play. But if it did happen, that's the thing to be prepared for. We can see strong New Zealand dollar buying. In terms of potential currency pairs that would be helpful, in a scenario 1, okay, now this is assuming that if the RBNZ are more dovish, and if yen keeps strengthening on global growth concerns, then New Zealand dollar Japanese yen pair would be a strong sell. Okay, so let's just look at some levels. Okay, so looking at the New Zealand dollar Japanese yen. Okay, so that's the daily chart. Let's put a Fibonacci retracement level on. So going from the top down to the lows, you can see there's a couple of levels here that stand out to me. There is, so you got this support level here, and you've got this, sorry, just get another trend line here, and you've got this sort of support zone, really. Okay, put it around there. So if we did get a dovish RBNZ, then okay, yeah, so that this level here looks very interesting to me as I put that together. You've got a confluence of factors. You see, you've got the support, got the S1 pivot point, got the S1 pivot point here, and that is the 38 percentage retracement level, and it's 70.50 level. So a dovish RBNZ, then looking for shorts from this level would make sense. That's where I'd expect to see sellers on a test of that level, and if that level broke, then you'd expect to find sellers at this level, again the 50% possibly, but then I'd be looking for sellers up here at 71.50, so 70.50 or 71.50 level, and you know, potentially managing the trade from behind. You expect breaks on stops above 73.50. So that would be the kind of level, and then you could just, you know, traders would be looking for an extension move down. This would be more of a swing trade, and they'd be looking for a move down on the, you know, the extension of that fib level down sort of 68 and below. So that's, you know, that's in the situation of a dovish Fed. That's the sort of thing that I'll be looking at. If they go to a more kind of neutral setting, you could see some New Zealand dollar strength on a sell the rumor, buy the fact type of trade, and that could, you know, one potential currency pair would be Euro New Zealand dollar sell. So at the moment, you know, we're having Euro strength against the New Zealand dollar, but if there was a, you know, a more neutral setting, then we could potentially look at some downside on the Euro New Zealand dollar pair. On the daily chart, you know, looking at some of these support and resistance levels, that will be an obvious retest back. You can see it's supported there. We're getting some kind of reaction here. You can see a breakdown and a return up to that level would be interesting. Just see if we've got any pivot points. Yeah. So again, you know, that R1 pivot point looks like potentially a good place to sell from, and failing that above the R2 level, you know, and you'd expect traders, you know, stops to be placed above, you know, 1.7400 handle would seem to be a logical place. You might see retrace back up to that level and then moving back down, or down, back up, and then back down to this pivot point. So that's the kind of areas technically we'll expect to find, you know, sellers on resistance from this level, from that level, and then some profit taking on this level, potentially with the 100, 200 moving average as well. Third scenario, you know, that would be an unlikely outlook, but that would be consider a Euro New Zealand dollar sell in that one, but then that would be quite extreme. Okay, obviously the thing with this New Zealand dollar Japanese yen sell remains with the view that there's still this kind of negative risk sentiment in the market. And again, just a reminder to be looking at the equity markets to get a feel, get a gauge, get a handle on what's happening with risk. Some of these, you know, recovery in inverted commas isn't so much you know, it's a bit of profit taking. It's a bit of, you know, it's not extending lows, but we're still some way away from a, you know, a big recovery, and we've got the US-China trade war still, you know, fully underway. So we're certainly not out of the woods by any means. But I think that gives us a picture. I hope that's a helpful, you know, kind of, you know, summary in a difficult situation. And again, it's just a reminder. Oh, sorry, Nadir, I hope you do. Pound US dollar, yeah, let's. I think pound US dollar again, Hashik, I think that makes sense. Let's have a quick look at the pound US dollar. Hashik, I'm just gonna pull that up for us. The pound remains a sell on rallies. I mean, the US dollar has been strong recently. The Federal Reserve was not as dovish as feared. The only thing about the US dollar, which has been, you know, a little bit confusing, is that the dollar has been, you know, the dollar index was sold off on Monday, and it took me a little bit by surprise. So it's not. The dollar index is up today, which is, you know, reassuring, and I think the fundamental picture for the US dollar is strong. So there we go. Okay, here we go. So let's just zoom out. Let's see where we are with the pound US dollar pair. Okay, so we got, first thing to be aware of, we've got some big support level down here, the 1.2 level. Okay, so that's the first thing to notice. So we're going to expect some reaction from that 1.2 level, and we've already seen a move towards it. Okay, on the daily chart, you can see an area that I've got marked in up here. I would be very interested in selling from this 1.23 handle. I think you expect to find sellers on a return to this level here. And on the 4-hour chart, we can see that price is just testing the pivot point on the 4-hour chart with the 100 moving average above. So, you know, for me, the problem with going short here is, look, it's just, you know, you might have to see prices come quite a long way. So the problem with going short here is you might have to sit under quite a lot of drawdown until you return back testing these long-term lows, and you might well get another strong bounce off here. So for me, for the pound US dollar pair, Hashik, yes, sound. The pound is a sell on rallies. Yes, we're expecting US dollar strength. Okay, because the Federal Reserve is less dovish than expected. US data has been holding up. So they are going in different directions, the pound and the US dollar. But the levels where I'd expect to find sellers, I expect to find sellers up here, from 1.2323 to 1.2400. That's what I expect to find sellers, and I expect traders to anchor their stops above the 1.2500 handle, so 1.2532. For me, makes sense because you've got that resistance level up there. So if price does break through here, there's a chance that it hits that resistance level and comes back down. You know, targets would be these recent lows at 1.21 or target here at the pivot point. That's what I would make sense of that. Guys, we've been a really good time. We've covered a lot. I hope you found that helpful. We've come to the end of our time together. Yeah, you're welcome, Hashik. Don't forget, guys, you can always use the question and answer panel on a week-to-week basis. Don't forget to ask questions, especially some of you regular guys who've been here for some time. You know, Van, Dear, Sammy, Ram, Aaron, Amelia. You know, please do use the question and answer panel so we can, you know, try to be as helpful as possible. Thank you for attending the webinar, and I look forward to seeing you guys on the FX week ahead on Monday, next Monday, 12:30 GMT time, and we'll be looking at the most significant events, scheduled events for the coming week. Take care now, guys, and have a really good week. Thank you. Bye.